We'll start with the quiz. ZZCo uses the EOQ model for inventory management. A decrease in one of the following variables would increase the EOQ. So what we'll do is we'll have the EOQ formula. EOQ formula is 2AB divided by CS to the, it's a square root. Okay. So he's asking when EOQ would increase for in the decrease of which of these numbers. The first one he is asking cost per order. So cost per order is B. If B reduces, okay, as the numerator reduces, the EOQ will also reduce. So this is not the answer. Level of buffer stock. Level of buffer stock does not have any relationship with EOQ. So we can strike off buffer stock. Holding cost. So holding cost is a denominator, the S. If S decreases, okay, then the overall answer increases and also EOQ increases. So holding cost should be the answer. We'll also check D. Quantity demanded. Quantity demanded is A. If A decreases, the numerator decreases and as well as the entire EOQ answer decreases. D is not the answer. So the answer should be C. The answer is C. So now we'll move on to the reorder level. The company needs to identify a level of inventory at which order should be placed. Okay. We'll look at an example. The ROL is the quantity of inventory at which order is placed. When the demand and lead time are known with certainty, the ROL may be calculated exactly. So the reorder level is demand in the lead time. So that is what this ROL refers to. So ROL can be also calculated using this formula: maximum usage into maximum lead time. So we'll look at a graphical explanation about it. So for example, assume that you already have inventory level here. Okay, you have around some 1000 units of raw materials and you keep on producing more finished goods. So what happens is the raw material keeps on going down. Okay, it keeps on going down up to even a point of 0, but you can't wait up to 0. That is a very bad thing, because if inventory goes to 0, if raw material goes to 0, then you can't do production. So what you do is, when you create a reorder point or a reorder level, that is when the raw material inventory falls to up to a level, okay, you make an order to the supplier. So the supplier, assume that he takes 1 week lead time, so this is the 1 week. So if you make an order here, he will give you in 1 week's time the inventory. So what happens is your inventory keeps on going down. Okay, so when he gives you the fresh stock, you top up it. So your top up is something like, if it becomes 0, again he gives you 1000 units of raw material. So from 0 it again goes to 1000. So again the same thing happens. So the inventory again reaches a threshold point of reorder level. So at that point of time, you make an order to the supplier. Supplier takes 1 week's time and he again gives you. So where does this line go? From 0 units, you add 1000 that you get from the supplier. So again it will go to here. Okay, so it will reach the 1000 level. So what is the reorder level here? It can be something like 200 units. Okay, so at 200, so at every 200 units, you are going to keep on reordering. So the same thing keeps on happening. So again we order where? We order at the 200 level. So that is about the reorder level. So now we look at what is a just-in-time system. Just-in-time refers to purchasing raw materials and components when required and producing finished goods only when needed. So just-in-time operates in two ways. So one is called as just-in-time purchase and the other one is called as just-in-time production. So what you do is, only when the unit is required you are going to produce, that is called as JIT production. Only when the raw material is required you are going to purchase, so that is called as the JIT purchase. Thus the objective of JIT is to reduce the inventory close to 0. Which inventory? Both the raw material inventory and the finished goods inventory. Thus purchasing and producing are made just in time when needed. Just-in-time system requires the following. So in order for just-in-time to work properly, we need these things. Number one, a flexible manufacturing process. So the machines should be able to produce as and when required. So even a small batch of units should be able to be produced. Okay, small batch. What is a small batch? The small batch or the ideal batch in JIT is 1 unit. So even for 1 unit of a product, the machine should be able to produce it at an economical cost. That should be a very good relationship with the supplier. Then only, even when we ask just 1 unit of raw material, he will supply us multi-skilled employees. So employees should be skilled in using all types of machinery in the company. So what is the benefits of operating a JIT? It helps to reduce the inventory and also the holding cost. So the ideal holding of finished goods and raw material is just 1 unit. Okay, it reduces the manufacturing lead time. So whenever you ask for 1 unit of raw material, it should be like immediately delivered. So it should not take something like 1 week and all. It should be available even in 1 hour or even less than that. Better utilization of labor. So labor are going to be used only when required, not in the sense like to produce more units. Only when the unit is required, they are used. It is reduced scrap and rework. Every 1 unit produced, every 1 unit of finished good produced should be 100% good. Okay, so there is no wastage at all. So even if you can add, this leads to no wastage because all goods that are produced should be of 100% good quality. So 100% quality is what they aim for. Thus, JIT leads to lower levels of investment in working capital. So our logic is to link JIT with the working capital. So that's about the benefit. So here we will be like discussing about the receivables management. From an exam point of view, receivables management is a very important chapter. You get both theory topics and as well as problem topics. So ensure that you understand these problems and theory topic well. So first we look at what is the techniques in managing the trade receivables. So trade receivables actually refers to the credit sales that has been made, or it can also be referred to the debtors of the company. So trade receivables is a huge part of a company which is going to make sales, trade sales. Okay, so there is a technique in managing the trade receivables in a company. So the first thing we have to do is we have to assess the creditworthiness of the potential customer, the potential credit customer. So we should not be like selling to each and every guy who asks for good. We have to verify whether they are able to pay the debt in the future. Periodical review of receivable. So once you have made credit sales, we have to periodically find out whether the receivables are being collected properly or not. So collection of the amount owing. So we have to collect the amounts. Offering early settlement discount. So we give them some kind of a discount and try to get the receivables quickly. Using factoring and invoicing discounts. So we use some other methods to convert the trade receivables into cash. And finally, managing foreign accounts receivable. So this is a separate topic which you'll see later. So we'll start with what is assessing credit worthiness of a credit customer or a potential credit customer. A firm should assess the credit worthiness of existing and potential credit customers. So they have to find the background of the potential customer. So how do we know like whether they are credit worthy or not? We have to use the following information. So we have to ask the bank, the customer's bank, whether they're good enough customers or not. Trade reference, we ask any other we ask any other supplier to that customer, like whether we can also supply to them or not. We can look at their annual report and do ratio analysis and find out whether they are liquid or whether they have profitable. So we can do a ratio analysis and find that. We can get a credit reference agency's report. So this report tells like how much credit worthy they are and can we lend any can we sell goods on credit, the company's existing records, and any credit score that they might have. So based on these information, a company can process the credit sales. So what is periodical review of receivables levels? The position of receivables should be regularly reviewed as part of managing the overall working capital and corrective action taken when needed. So assume that a company is like dealing in a lot of credit sales, so the receivable level is like high, and this receivable levels have to be like constantly monitored and has to be followed up by the company. So how do we like follow up and analyze the receivable levels? Number one, we have to do something called as an age analysis. So age analysis, it classifies like assume that we have sold 10 lakhs worth of goods, okay, and this has been sold to 100 customers. So we have to find, okay, out of this 100 customers, 10 customers might have taken 2 months already to pay, and 80 customers have taken around some 1 month of time and still they have not paid. The balance 10 customers might have taken only like half a month and still they have not paid. So this helps the company to follow up on the receivables. For example, the 2 month customers have to be like pressured more and we have to get the money, and this 1 month customers we can still give them 1 month and then we can put them pressure on them, but now we have to remind them. For the 0.5 month customer, we don't need to much follow up with them because now only we have given them a credit, we can still wait. So that's about the age analysis. So it divides the customers based on the outstanding months. So the next one is ratios compared with previous period or target to indicate trends in credit levels and the incidence of overdue and irrecoverable debts. Receivable days, okay, the receivable days indicates like how many days the debtors are taking to repay. So assume that the receivable days have been like 100, okay, but in the previous year it has only been like 70 days. So it means that this year we are like our debtors are increasing their time to pay us. So what we should do is we have to take some really tough action to ensure that we receive the cash payments. So the next one is called a statistical data. So we can use statistical data to identify cause of default and the incidence of irrecoverable debts among different classes of customers and types of trade. So a company might be like selling to different types of customers. So what happens is we have to find out which customer are not paying on time and which customers are like defaulting on their money. So we have to find out which customer behaves in what manner. So statistical analysis helps us that a particular group of customers might be defaulting, a group of customers might be delaying the payment. So what we do is once we have identified these sets of customers, then we can take an action in terms of putting a penalty on them or not selling to that group of customers. So it statistical analysis and statistical data helps us in a lot of ways. So that's about the periodical review of receivables. So the next one is collection of amounts owed. So how do we collect from the customers? There are steps in collection of amounts owed. So the first one is an invoice should be raised when a sale is made. Regular statements should be sent. For example, on a monthly basis, we have to send it to each customer as to how much amount is due from them. Customers should be encouraged to settle their accounts on time and not become overdue. Offering a discount for early settlement could help to achieve this. So we could offer them some kind of a discount and we can get the amount. Reminders of payment due should be sent leading to a final demand if necessary. So if the customers are not paying on time, we can then issue a very strict notification saying that we require the payment on a prompt basis. We can also make telephone calls, or even we can make personal visit to their company, so that a contact within the company can always be established. If we have done all these steps and still the customers are not paying, then we can take a legal action on them, or we can employ a specialized debt collection agency who can who can have a tough hand in solving the problem. So these are the steps in collecting the cash. So this have been asked in ACCA exam like once or twice, so ensure that you understand these steps. So we look at what is an early settlement discount. Early settlement discount may be given to shorten average credit periods and to reduce investments in accounts receivable and therefore interest costs of the finance involved in trade receivables. See, the problem with trade receivable is, see, the trade receivables is not a free amount. The trade receivables is usually like financed through loan or overdraft. This loan or overdraft does not come free. We have to pay interest for this loan and overdraft. So what happens is, the more and more time the trade receivables takes to pay, our customers are taking time to pay, the more the interest that we have to pay. So if we can get the trade receivables very quickly, okay, then we don't need to take a loan, and then we don't need to take a interest also. So what happens is, the sooner the receivable that we receive, we don't need to pay interest on the loan, because that can be settled. So what we do is, we are trying to give a early settlement discount to encourage the trade receivable customers, okay, to encourage the credit customers to pay for the due date. The benefit in interest cost saved should exceed the cost of the discount allowed. Okay, so that is what we want. For example, if our overdraft loan is something like 20%, okay, and the early settlement discount that we give is a cost to us, right? It is a cost to us because we are giving a discount. That discount should be less than the OD. For example, it can be like 12%. In such cases, we can go with the early settlement discount. So the benefit in interest cost saved should exceed the cost of the discount allowed. So that is what is being mentioned here. So we look at what is the cost of an early settlement discount. Cost of early settlement discount. So this is a formula. We'll work out the formula later. So D refers to the discount rate, and days refers to the difference between old credit days and new credit days. See, this formula ESD can be worked out for a receivable as well as a payable. Okay, if and for both the receivable and payable, the formula remains the same, but the interpretation differs. If calculated for receivables, then cost calculated should be below the overdraft rate. That is, if the overdraft rate is 20%, then the ESD, the early settlement discount cost, should be only like less than that, 12%. So which one should we go for? If the overdraft, if we borrow a loan from bank, it is 20%. If we give the early settlement discount, it is like 12%. Then it is better to give an early settlement discount. So that's how it works. So if you are going to calculate the same formula for payables, then cost calculated should be above the overdraft rate. Why is it like so? Because, so if you are going to quickly settle the payables, what happens is, we have to take an overdraft and then only pay the credit suppliers. So assume that the overdraft rate is 20%, we have to borrow at 20% and make the payment to the suppliers. If the overdraft itself is 20%, then the ESD here becomes a benefit for us. The benefit that we get through early settlement discount should be something more than the overdraft. So that's how it works. So in terms of receivables, the ESD should be below the overdraft, and in terms of payables, the ESD should be above the overdraft. So from an exam point of view, this is an important point. So we'll move on to the next one. So we look at what is a change in collection policy and its effect. So this might be asked as a numerical question. So what you do is, you try to find out the old system variables. Okay, so you take the old system's interest and bad debits, and you find out the total cost, and then you arrive at creating the new systems what new system or new policy effect. So you find out like how many of them are accepting the discount, how many of them who don't accept the discount, their interest rate, and what is the discount offered, what is the administration cost, what is the bad debits. So these variables usually depend upon the sum, but still you can have this as a rough format to solve this kind of changes in collection policy and its effect type of problems. Okay, so we can look at a problem later. So we'll look at what is a factoring. So factoring is a financial transaction and a type of debtor finance in which business sells its accounts receivable, that is the invoices, to a third party at a discount. So we look at this picture. There are like three parties involved in a factory. So one is the company, and the other one is the credit customer, and the other one is the finance company. So the first step is, once the credit customer has bought goods from ABC, ABC company is going to send the invoice, and it also sends a copy of that invoice to the finance company. So the finance company immediately gives 90% of the amount of the invoice amount to the ABC company. So ABC company has quickly got its cash. So the next step is, so the finance company after a week or after a month, based upon the credit period, okay, he asks the credit customer to make the payment. The credit customer makes the payment and the finance company has received that amount. So the finance company now gives the balance 10% of the cash to ABC Co. But the thing is, he will deduct his fees for the amount that he has already given. He will charge an interest, and also for following with the credit customer, he takes some kind of a administration charge. So both these charges he takes into account. So he deducts his fees and remits the balance to the ABC company. So we look at what are the different types of factoring. The first one is called as a recourse factoring. So recourse factoring works like this. Here the company sells its receivable to the factoring company with the understanding that the company is responsible for the uncollected receivable. So assume that ABC company has sold 10 bills, okay, 10 bills to the factor company. The factor company is able to get money on 8 of those bills, but 2 bills are not able to be recovered. Okay, so 2 customers are not paying. So in recourse factor, the factor will send these 2 bills to ABC Co. So ABC Co will take care with the 2 bills and 2 customers. This factoring plan is comparatively low cost. So why is it low cost? Because the factor is not taking the risk of the unpaid bills. So he sends that unpaid bills to the ABC company. So the next one is called as a non-recourse factoring. So here what it happens is, the factor does not send the unpaid bills, but what he does, he keeps following up with the 2 bills. Okay. So here the company sells its receivables to the factoring company with the understanding that the company is not responsible for the uncollected receivable. This factoring plan is comparatively high cost because the ABC company will get its 90% of cash upfront from the factor. Okay, so the factor then keeps on chasing the 2 customers for the 2 unpaid bills, and he is responsible for taking care of the bill. So irrespective of them paying the money or not, the ABC company has got its 90% of amount. So that is called as non-recourse factoring. So what is the benefit of doing all this? See, the factor is an expert in collecting the receivables. So if we give it to them, they will be able to chase the customers properly. Access to liquidity. So the factor gives 90% of the cash upfront, and the factor collects the cash in 2 months time or 1 month time from the customers, and he gives the balance 10% of the cash in that 2 months time. So we have a good amount of liquidity. We have 90% of the money. So there's also lower administration cost. We don't need to appoint customer service executive. We don't need to appoint a person to collect the debts, or we don't need to manage the receivables at all. It's all given to the factor. The factor now does all the administration work. So we can also have an insurance against the bad debts. For the example, in non-course, even the two bills which are unpaid, even for that the factor pays us. So he takes the risk of bad debts. So we'll have a quiz. Which of the following statement is correct? Factoring with recourse provides insurance against bad debits. It's non-recourse which is giving the benefit, not the recourse one. So this is wrong. The expertise of a factor can increase the efficiency of trade receivables management for a company. Yes, if we are not an expert in collecting trade receivables, but they are an expert, so of course they can do it. So option A is the answer. Option A is the answer. So now we look at the factoring format. So to solve a problem, this is a format for factoring. So this is the old system. So we look at this format while doing a problem. So we'll start with what is an invoice discounting. Invoice discounting is the practice of using a company's unpaid accounts receivable as collateral for a loan which is issued by a finance company. So we use the accounts receivable bills as a collateral here. The amount of debt issued by the finance company is less than the total amount of outstanding receivables. So typically 80% of all the receivables money will get. So it's not that 100% of money will get, at least 80% of money will get. Invoice discounting essentially accelerates cash flow from customers, so that instead of waiting for customers to pay within their normal credit terms, the business receives cash almost as soon as the invoice is issued. So we don't need to wait for the customers to pay us. We can give it to the financing company and raise cash immediately. So we look at invoice discounting graphically. So we'll again take three companies. One is the ABC Co, and the other one is the credit customer, and the other one is the financing company. So ABC Co sells the goods to credit customers and then sends the invoice. It also sends an invoice copy to the finance company. The finance company makes 90% of the advance, and ABC company asks the customer to pay. The credit customer then pays the the finance company. So the credit customer pays the finance company. So the finance company then makes a deduction for the payment involved for them. They less their fees and return back the balance 10%. That is about the invoice discounting here. So we'll have a quiz. What does invoice discounting normally involve? Offering a cash discount for early settlement of invoices? No. Selling all invoices to a finance house who takes over administration of the receivables ledger? Again, the answer is no, because that is called as factoring. Receiving a cash advance from a finance house based on a percentage of face value of selected invoices. This is what is invoicing is. Writing off an invoice partly or in total as bad debt. No, this is not invoicing. So we look at the answer. So the answer is C.